So nobody's considering taking a 50-year mortgage because they want to save $150 a month, and over the lifetime of that loan spend extra hundreds of thousands of dollars on the same property. People would only be interested in looking at that long of a length of a loan so that they can get approved for the loan. You may know your budget and you may know how much you can afford to spend on a mortgage payment for a home. Just because you know what you can spend doesn't mean the bank agrees. They have a little calculation called a debt-to-income ratio, and if you fall outside of that desired range, meaning they believe you have too much debt compared to your monthly income, they will likely deny that loan application unless you can make that up with savings or a very high credit score. And so even though the 50-year note only lowers the monthly payment by maybe a couple $100s, what it actually might do is allow way more people to be in that desired debt-to-income ratio range. Whereas they may have known before they could have afforded the 30-year note mortgage payment, adjusting that monthly payment lower allows the lender's calculation to agree. My question is, how am I going to implement a plan to cover your mortgage for you and your family? Commonly known as mortgage protection insurance, which is different from PMI because that only gets paid to your lender, not your family. These are typically term plans that we put together for clients that match both the length of the note and the size of the mortgage on the home. If the borrower passes away, the death benefit gets paid out so the family can pay off that mortgage and remain in the home. Problem is, there are no life insurance companies issuing term policies for 50 years. And so my best recommendation here is to buy a convertible 30-year term policy. Hopefully once you hit close to the end of those 30 years, you've been able to prepay much of that mortgage or maybe even refinance. You have more assets, more income. When those 30 years are up, you no longer need such a large death benefit because you've paid down that mortgage. At which point then you could convert that term policy over to a more permanent, smaller plan that can remain after those 30 years to continue to cover whatever's left on the note.